What happens when 30% of the world's oil suddenly gets cut off overnight? In early 2026, that's exactly what nearly happened. Oil prices exploded, markets panicked, and within days, the global economy was pushed to the edge. But here's the real question. Was this just a temporary shock, or the start of something much bigger? To understand what's happening, you need to understand one thing. Oil still runs the world. Modern economies depend heavily on oil, not just for gas, but for shipping, aviation, manufacturing, and supply chains. And there's one place more important than any other, the Strait of Hormuz, a narrow waterway where roughly 20 to 30% of the world's oil supply passes every single day. Now imagine that choke point suddenly disrupted. That's exactly what happened on February 28, 2026, when conflict involving Iran escalated and effectively blocked this critical route. Before the crisis, global markets were already in a fragile position. Growth was slowing, inflation was still elevated, and central banks were carefully balancing interest rates. But energy markets were relatively stable. Then everything changed. Within days of the disruption, Brent crude surged toward $120 per barrel. Fuel costs spiked globally, and energy stocks surged as investors rushed for safety. According to reports, this was one of the fastest oil price increases in recent years. The effects spread instantly. Airlines across Asia cut flights and raised fares, shipping costs increased, and supply chains, already strained, faced new pressure. This wasn't just an oil story anymore. It was becoming a global economic shock. Then came the market reaction, and it was chaotic. In early March, the financial world saw what traders called a manic Monday. Major indices like the S&P 500 and the Dow Jones swung wildly within hours. Losses turned into gains, then back again. Why? Because markets weren't reacting to fundamentals anymore. They were reacting to headlines. Rumors of peace talks would send stocks up. New conflict updates would send them crashing down. Meanwhile, international markets took even bigger hits. Japan's Nikkei dropped sharply, and South Korea's Kospi entered correction territory with declines of 5 to 6% in some of the worst sessions. As oil stayed high, the real damage started showing up in the economy. First, inflation. According to data, U.S. wholesale inflation jumped to 2.9%, far above expectations of 1.6%. Gas prices surged. In just 1 week, U.S. gasoline rose by about 50 cents, hitting $3.48 per gallon. That hits everyone. Transportation gets more expensive, food prices rise, businesses face higher costs. Then came the second wave, interest rates. Because inflation stayed high, central banks were forced to hold rates higher for longer. Borrowing stays expensive, businesses slow hiring, and consumers spend less. Meanwhile, something unusual was happening in markets. A massive rotation. Tech stocks, especially AI-driven companies, started struggling. But energy and defense stocks surged. Investors weren't chasing growth anymore. They were chasing safety. Then suddenly, a shift. On April 7, 2026, a U.S. brokered ceasefire plan emerged, and markets reacted immediately. Oil prices dropped sharply, from near $120 down to around $92 per barrel. But here's the key: the damage wasn't undone. Growth forecasts for the Middle East and North Africa were cut from 4.0% to 1.8%. Global growth expectations were also revised lower. At the same time, U.S. inflation sits around 3.3%, OECD growth is around 2.9%, and markets remain highly volatile. Interestingly, analysts point to a possible oil surplus of over 2 million barrels per day, which means if stability holds, prices could fall further. But for now, uncertainty still dominates. So what does all of this actually mean for you? This crisis revealed something critical. The global economy is still deeply vulnerable to energy shocks. Even in a world talking about renewables and AI, oil still controls the tempo. Here are the key lessons. Energy equals power. When oil moves, everything moves. Markets react fast, but recover slowly. Prices can drop quickly, but economic damage lingers. Diversification matters. During this crisis, energy stocks surged, while tech struggled. Global events affect everyday life. From gas prices to food costs, this isn't just about markets. This wasn't just a geopolitical crisis. It was a financial wake-up call. Right now, the world is at a crossroads. Oil prices have pulled back. Markets are stabilizing, for now, but the system has already been shaken. If one disruption can move the entire global economy this much, what happens if it happens again? Amidst the unfolding crisis, the world watched anxiously as geopolitical tensions simmered just below the boiling point. The disruption of the Strait of Hormuz had not only highlighted the fragility of global oil supply chains, but also brought to the fore the critical importance of diplomatic interventions in mitigating such crises. As the ceasefire plan brokered by the US, global leaders scrambled to ensure that the temporary calm would transition into lasting peace. The spotlight turned to the Middle East, where the effectiveness of the ceasefire was being tested. Oil tankers hesitantly resumed their voyages through the Strait of Hormuz. The region's stability remained precarious. Analysts closely monitored the situation, aware that any misstep could reignite hostilities. The stakes were high. Failure to maintain peace could plunge the world back into economic turmoil. In Washington, D.C., policymakers debated strategies to secure energy supplies. The crisis had reignited discussions about energy independence. Lawmakers pressed for accelerated investments in renewable energy. Across the Atlantic, European leaders faced their own set of challenges. The European Union, heavily reliant on Middle Eastern oil, found itself in a precarious position. The crisis had exposed the vulnerabilities of its energy strategy. European nations began exploring alternative sources, including increased imports from Russia and North Africa. In Asia, the ripple effects of the crisis were acutely felt. Countries like Japan and South Korea, with limited natural resources, found themselves at the mercy of fluctuating oil prices. Their economies, heavily dependent on energy imports, struggled to cope with the increased costs. Governments implemented emergency measures to alleviate the burden on consumers. The private sector, too, was forced to adapt. Major oil companies scrambled to stabilize operations. They reassessed supply chains and invested in technology to increase efficiency. Energy companies faced mounting pressure from stakeholders to embrace sustainability. Amid these economic adjustments, the human impact of the crisis was starkly visible. In developing countries, where energy costs formed a significant portion of household expenses, the price hikes had severe repercussions. Communities already grappling with poverty found themselves further marginalized. Rising costs of transportation and goods exacerbated existing inequalities. The crisis highlighted the need for global cooperation in addressing energy poverty and ensuring equitable access to resources. As the world grappled with these challenges, the role of international organizations gained prominence. The International Energy Agency, IEA, and the Organization of the Petroleum Exporting Countries, OPEC, were thrust into the spotlight. They were tasked with coordinating efforts to stabilize markets. They facilitated dialogues between oil-producing and oil-consuming nations. Their goal was to balance supply and demand while preventing further escalation of tensions. In the financial markets, the crisis had left a lasting imprint. Traders, once reliant on predictable patterns, now navigated an environment dominated by uncertainty and volatility. The experience underscored the importance of sophisticated risk management strategies. There was a need for adaptive financial systems capable of withstanding external shocks. As the dust began to settle, attention shifted to the lessons learned from the crisis. It became evident that while the world had narrowly averted disaster, the underlying vulnerabilities remained unaddressed. The crisis served as a stark reminder of the interconnectedness of global systems. There was a need for comprehensive strategies to safeguard against future disruptions. In academic circles, the crisis sparked renewed interest in energy economics and geopolitics. Scholars analyzed the complex interplay between energy security, international relations, and economic stability. They produced research that would inform policy decisions in the years to come. The crisis also highlighted the importance of technological innovation in transforming energy landscapes. This prompted increased funding for research and development in renewable energy technologies. As the world cautiously moved forward, the crisis remained a pivotal reference point in discussions about energy policy and global security. It was a testament to the challenges of the 21st century, where economic resilience and geopolitical stability were inextricably linked. The events of 2026 would continue to shape global agendas. These events influenced decisions on energy, technology, and international cooperation for years to come. But for now, the world remained on edge, aware that the next crisis could be just around the corner. The world was waiting to test the resilience of global systems once again. As the world continued to adapt in the wake of the 2026 oil shock, attention turned to the technological innovations that could offer a path forward. The crisis had underscored the urgent need for alternative energy sources. This thrust renewable energy technologies into the spotlight. Governments and corporations accelerated investments in solar, wind, and hydrogen energy, seeking to reduce reliance on fossil fuels and build more resilient energy systems. In Silicon Valley, tech companies raced to develop new solutions, with AI and data analytics playing a crucial role. These technologies were harnessed to optimize energy consumption, improve grid resilience, and forecast energy demands more accurately. Startups specializing in energy storage and battery technology saw a surge in interest and funding. Efficient storage solutions became paramount for renewable energy viability. Meanwhile, the automotive industry faced its own challenges. With gasoline prices having spiked, consumer interest in electric vehicles, EVs, soared. Automakers ramped up production of EVs, while governments offered incentives to encourage adoption. Charging infrastructure expanded rapidly, with investments flowing into fast charging networks. In the realm of policy, international cooperation became a focal point. The crisis had highlighted the interconnectedness of global energy markets. Nations strengthened alliances and collaborated on energy security. New treaties and agreements emerged, focusing on shared energy resources. The International Energy Forum expanded its mandate. The crisis also influenced geopolitical strategies. Nations recognized the strategic value of energy independence. Countries with rich renewable resources found themselves in advantageous positions. Regions heavily dependent on oil imports sought to diversify their energy sources. As the immediate panic subsided, the financial markets began to stabilize. Investors became more discerning, favoring companies with robust risk management practices. The crisis accelerated the integration of ESG considerations into investment decisions. In academia, the crisis inspired a wave of research into energy transitions and sustainability. Universities established dedicated research centers focused on renewable energy technologies. Scholars collaborated across disciplines, pooling expertise to address energy challenges. For ordinary citizens, the crisis prompted a re-evaluation of consumption habits. Awareness campaigns emphasized energy conservation and efficiency, encouraging individuals to reduce their carbon footprints. Public transportation systems saw increased usage as commuters sought alternatives to driving. In urban planning, cities prioritized sustainable development. They incorporated green spaces and energy-efficient buildings into new projects. Amid these transformative changes, the media played a crucial role in shaping public discourse. News outlets provided in-depth coverage of the crisis. They highlighted both the immediate impacts and the broader implications for global economies and societies. Documentaries and investigative reports delved into the complexities of energy geopolitics. They offered audiences a deeper understanding of the forces shaping the world. Despite the progress and adaptation, challenges remained. The transition to a more sustainable energy future required significant investments. It also required technological breakthroughs and political will. Developing countries, in particular, faced hurdles in accessing the resources and technology needed for energy transitions. International aid and partnerships became essential. Developed nations offered support to ensure an equitable energy transformation. As the world looked to the future, the lessons of the 2026 oil shock remained at the forefront of global consciousness. The crisis had exposed vulnerabilities, but also catalyzed innovation and collaboration. It underscored the importance of resilience, adaptability, and foresight. In the final analysis, the 2026 oil shock was more than a moment of economic upheaval. It was a catalyst for change, prompting a reimagining of energy systems and international relations. As nations, industries, and individuals charted new paths forward, they did so with a renewed commitment. They aimed to build a sustainable, secure, and interconnected global community. The world, now more aware than ever of its interdependencies, stood poised at the dawn of a new era. The journey, fraught with challenges and opportunities, had only just begun.